What do you mean by price floor on the secondary market?
Yeah, so the price floor is a feature that we were waiting to release to come out of beta. And there's several reasons why we introduced the price floor. So, in a normal public market, you'd have, retail investors all around the world trading with institutional investors that would also be trading with longer term investors that might be investing for your pension. And you put all of those ginormous pockets of money together, from universities investing through funds and endowments to all of these different ginormous pockets of money, and it makes up the public markets. And because of that, you have this concept called liquidity. And liquidity means that when you want to sell, there's normally a buyer. And when you want to buy, there's normally a seller. And so you have a very efficient price mechanism. Such a price mechanism and liquidity does not exist on the secondary market. These should still be seen as long-term investments, and so therefore, and because they're restricted private investments, you don't get the same level of ability to market, for example, and so marketing is restricted, and therefore, you don't have that big pool of buyers and sellers creating efficient pricing. So one thing that we noticed was happening is that when we launched a new deal on the secondary market, through nothing to do with the value of the company and the success of the company, there would be investors that wanted to sell simply because they needed liquidity, or they wanted to invest into something else, or their circumstance has changed and they wanted to buy a house, or whatever it might be. And so these personal reasons for wanting to sell have no reflection on the value of the company. And because it's a more restricted market, you'd find that there would be a lot of people that wanted to do that. They would just be racing with each other to try and sell by entering a lower price, and then a lower price, and a lower price. And so really you got this downward pressure on price that had nothing to do with the value of the company. That causes a few problems for both the company and the other investors. The patient investors start to feel that even though there's this company that's been valued at a much, much higher price in the private, through a venture capitalist investing, but then their SPV shares might be at a lower price. And so that is demotivating for an investor and can cause them to want to sell because they think there's something wrong with their investment, when really it's got no reflection on the valuation of the company at all. The second thing is that when the company, if they're succeeding, they're going to be doing further funding in the future. And the goal of a company that is on a growth path, let's take a company like Kraken. If they're on a massive growth path, their goal is to sell shares at a higher valuation. So when they sell shares at a higher valuation, it sets a new price, a new value for the company. But one of the problems we had with Kraken is that when we did funding for them, that was at a time when no one was interested in investing, or our industry was a lot smaller. But now they didn't need to do funding because they grew so fast and they became such a profitable company that they didn't necessarily need to do any funding. So what was the value of that company? Well, it's very hard. So then they go and do another funding round, and now the industry has determined through investments that they're worth 4 billion. So what we do is we take the price of that last funding round and set it as a price floor, so that if you want to sell, no problem, you can enter an order there, but the lowest you can set the price is the last funding round. So then Kraken come and does another round, and then we set a new price floor. And so those that got that entered into the market before the new price floor was set, as long as that is at a significantly higher price, then everybody is selling at either the same price or a higher price. So this, what we thought was the best way of tackling simultaneously those two issues. Also what we had found is that when somebody wanted to buy into Kraken with a long-term vision, they weren't necessarily, they were willing to pay the right price. And so really setting a lower price didn't really drive more buyers in. And so now that we've got this price floor feature, everyone can be happy, the companies that can be happy, investors can be happy that those that are less patient or not in a position don't mess up the valuation. And it was really the missing feature that made us comfortable in introducing many more deals to our secondary market, so we can then focus on that goal of allowing people
high risk, high reward type of investment. But creating a secondary market that is aligned with the business that is raising funding is good for the business, but it's also good for the investors. But to make that secondary market fruitful, all of the incentives have to be aligned between the company raising funding and having to go through multiple rounds, the investor that wants to support it and take that risk, but knowing that if they need to, that they're in a position that they can sell their shares at a later stage. Maybe they have to hold it for a year, but at a later stage, they're able to sell their shares if they need to. And so we want to ensure that that three-way relationship works really well. Secondary market, prime investors that are happy in the primary market offering, but also companies that are willing to work with us on enabling that secondary market. And I think it's a wonderful thing, to be able to introduce that for private markets, and in particular for the crypto market that's on a high growth trajectory. But to do it, we've got to do it in a way that all the incentives are aligned. And this price for feature really ensures that that is the case. And from that, we can expect, of course, we can't anticipate what will happen when we come out of beta, but we can anticipate that, we won't see a reduction in volume. I don't think that will be necessarily the case, because it will give confidence both to the person who's raising funding and also to the investor that's investing, that this is a solid investment and that has longevity. And so it's just a question of what are your personal circumstances and if you need to get out. And people that missed out can come in, and that the company that raised the funding in the first place feel that they're following along in the same journey and that they're not being disadvantaged in a certain way. So it's purely about alignment to then produce an effective secondary market.